I'm Marilyn Weston, and you're getting it straight from a woman's perspective here on Zoomer Radio. And we find ourselves at December the 29th, almost at the beginning of 2019. And we always start the show talking about investing tax efficiently with Darren Farwell or someone from the Farwell group. And last week, Darren was in, and he basically told us not to be emotional and make emotional decisions when the market is volatile. And he gave us 3 tips so that we could survive this coming volatility that he predicts in 2019. And he's back with us this week, and I'm kind of curious to hear if he has a happy story or exactly what wisdom he has for the new year. So good morning, Darren.
Good morning, Marilyn. That was a great summary of what we talked about last week. We are anticipating some volatile markets, and I gave a couple of tips for how to handle what's coming up in 2019. You know, I was walking around on Boxing Day looking for some deals, and you wouldn't know that people are worried about the economic recession by the crowds out there on Boxing Day.
Everybody wants a bargain.
It was packed. Well, now that that's over, it's time to start potentially thinking about paying the bills. And last week I spoke about our outlook for 2019 and what about these crashing stock prices. By the way, I gave an outlook last week. I'll be giving a formal outlook for what's coming up in 2019 on January the 31st. And so any listeners who'd be interested in attending a seminar, my presentation about Outlook 2019, feel free to give me a call. But based on what we know at the moment, our outlook is really much better than many people seem to be afraid of. But whether that ends up being a positive outlook for the year or not, either way, there's going to be a lot of volatility on the upside, markets going up, but also on the downside. But the grim forecast of economic recession in the U.S., in my professional opinion, is premature. Me, Leslie, and my team, the Farwell Group, spent a lot of time considering all of this and helping to determine how to best protect our clients' wealth and sustain a tax-efficient, reliable lifetime income. In particular, there's a growing number of women, some of whom are widowers, who are now having to navigate these rough financial waters on their own as a result of the death of a partner or spouse. It's not that they can't do it themselves or aren't capable. It's more they just haven't, for one reason or another, done so in the past. Me and my team have special tools and expertise in helping widows, a group in which Leslie calls in her new book a suddenly single. One such suddenly single woman, Lois, called me after the show last week. Lois asked me to clarify what I meant by ensuring her income needs from her investments are secure. Well, at the same time, as I talked about last week, ensuring that your money, your capital, continues to grow so that you can continue to be comfortable throughout your retirement, the rest of your life. Well, here's how Lois's story unfolds. Lois has done her work. She's done the monthly budgeting and determined she needs $90K per year to live the lifestyle she enjoys. Lois gets $18,000 per year from her Canada Pension Plan and old age security benefits. Lois also has a survivor's defined benefit monthly payment from her husband, so that defined benefit is another $36,000 a year. Now, these are fixed incomes, but fortunately, they're indexed, and that's a very powerful thing to have for any of your financial benefits that have been indexed. The other kind of fixed benefit she has is her RIF. And you consider it fixed, particularly if you are taking the required minimum withdrawal each year, which Lois is. She's taking that withdrawal pre-tax, and from that, she gets $22,000 a year. So bottom line, Lois needs her investments to generate enough to make up the gap between her fixed incomes, government pensions, defined benefit pension, and RIF, that's $76,000 a year, and her spending needs, $90,000. So she needs to make up $14,000 plus her taxes, which tend to be about $20,000 a year. So call it $40,000. With a portfolio of $800,000, that's a 5% rate of return. So Lois is going to get that kind of cash flow from just GRCs or cash. So here's the solution. In one bucket, she puts $40,000. Remember, that's the amount of money she needs to spend each year for income and taxes. So it's $120,000 in a bucket of risk-off investments. They will make 2.5% to 4%. They won't really make any more, but they won't go negative no matter what happens in the stock market. By putting that money in risk-off, it allows Lois to feel comfortable and secure because she can see that the value of those investments, the place where she gets her income from, isn't going up and down. It's very steady. But that also frees up the balance of her savings to be invested more long-term for capital growth that ensures that her money will be down the road. We call that bucket risk on. But because Lois is sort of a nervous investor and she doesn't want to lose sleep because of investments, we're investing that bucket moderate risk, not really all pure growth. And so that avoids the number one wealth destroyer, which is when people sell good quality investments at a bad time. It's just as bad to sell good quality stocks when their prices are very low as it would be to sell your house if someone put the value at half price. So longer term, we have Lois's risk-on bucket growing at 5% and her risk-off bucket being there to ensure that she has the income that she's going to need. That made Lois feel quite relaxed with the knowledge that risk-off was going to supply her income and risk-on was going to ensure that she had a lifetime of capital to supply her needs for income through the rest of her life. Now, Marilyn, we do have a booklet called Risk Off, Risk On, so you don't risk losing sleep. They'd be happy to share with any listeners who would like to hear a bit more about this strategy, as Lois did.
So that can be a belated Christmas gift or a New Year's gift. And if someone wants this booklet or they want to talk about their own financial plan and protect their future, how do we reach you?
The best way to reach me is to call 416-863-7501. You can also connect to us through our Facebook page, the Farwell Group. We have a connection directly to our team on our Facebook page. And we do also have some of these tips and strategies that you can see regularly updated on that Facebook page.
So the Farwell Group on Facebook or 416-863-7501. It's never too soon or too late to plan for a better outcome, and this risk-on, risk-off strategy is something that people can investigate and find out more about. All they have to do is call Darren at 416-863-7501. Thanks for starting off the new year with some great advice, as usual. Happy New Year, Darren, and a healthy one, and I'll speak to you next week.
Thank you, Marilyn. And I just wanted to add before we go, it's been a great year. I've enjoyed sharing so much of our Saturday mornings with you, Marilyn, and our From a Woman's Perspective listeners. And, you know, the new year, as we always say, it's never too late to plan. Anyone who would like to come downtown and have a meeting, we're happy to do some of this risk-on, risk-off analysis because it's very custom, it's very personalized. And if you'd like to have that personal, in-person conversation, we're glad to pay for parking and your coffee if you come and visit us downtown.
What a nice way to think of starting the year. So all the best, and thank you, Darren, for that generous offer. And we'll talk again next week.
All right. Bye for now, Marilyn.
Bye-bye. Happy New Year.